Okay, reading 26 of the CFA Level 1 program curriculum, reading on financial analysis techniques. Learning outcome, the candidate should be able to describe tools and techniques used in financial analysis using their uses and limitations, including their uses and limitations, classify, calculate, and interpret, activity, liquidity, and solvency, profitability and valuation ratios, describe relationships among ratios and evaluate a company using ratio analysis, demonstrate the application of dew point analysis of return on equity, and calculate and interpret effects on changes in its components. Calculate and interpret ratios used in equity analysis and credit analysis. Explain the requirements of segment reporting and calculate and interpret segment ratios. Describe how ratio analysis and other techniques can be used in model and forecast earnings. Introduction. Financial analysis tools can be useful in assessing a company's performance and trends in that performance. In essence, an analyst converts data into financial metrics that assist in decision-making. Assets seek to answer such questions as how successfully has a company performed relative to its own past performance and relative to its competitor. How is the company likely to perform in the future based on expectations about future performance? What is the value of this company or the securities at issues? A primary source of data is a company's annual report, including the financial statements and notes, the management commentary. This reading focuses on data presented in financial report presented under International Financial Reporting Standard and U.S. Generally Accepted Accounting Principles, the IFRS and U.S. GAAP. However, financial report does not contain all information needed to perform effective financial analysis, although financial statements do contain data about the past performance of a company, as well as the current financial conditions. Such statements do not necessarily provide all the information useful for analysis, nor do they forecast future results. The financial analysis must be capable of using financial statements in conjunction with other information to make projections and reach valid conclusions. Accordingly, an analyst typically needs to supplement the information found in a company's financial reports with other information, including for information on the economy, industry, comparable companies, and the company itself. This reading describes various techniques used to analyze a company's financial statement. Financial analysis of a company may be preferred for a variety of reasons, such as valuing equity securities, assessing credit risk, conducting due diligence related to an acquisition, or assessing subsidiary performance. This reading will describe techniques common in any financial analysis and then discuss more specific aspects for the two most common categories: equity analysis and credit analysis. I'm going to drink my green tea. I'm drinking unsweetened, chilled green tea today. Equity analysis incorporates an owner's perspective, either for valuation or performance evaluation. Credit analysis incorporates a creditor's perspective. In either case, there is a need to gather and analyze information to make a decision. The focus of analysis varies because of differences in interest on owners and creditors. Both equity and credit analysis assesses the abilities to generate and grow earnings, the cash flow, as well as any associated risk. Equity analysis usually places a greater emphasis on growth, whereas credit analysis places a greater emphasis on risk. The difference in emphasis reflects the different fundamentals of the types of investments. The value of a company's equity generally increases as the company's earnings and cash flow increases, whereas the value of a company's debt has an upper limit. The balance of this reading as follows in Section 2 recaps the framework of financial statements and place of financial analysis techniques within the framework. Section 3 provides description of analytical tools and techniques. Section 4 explains how to compute, analyze, and interpret common financial ratios. Section 5 through 8 explain the use of ratios and other analytical data in equity analysis, credit analysis, segment analysis, and forecasting, respectively. A summary of key points and practice problems in the CFA Institute multiple choice format and concludes the reading. Financial analysis process. In financial analysis, In financial analysis, it is essential to clearly identify and understand the financial objective and the steps required to reach that objective. In addition, the analyst needs to know where to find relevant data, how to process and analyze the data, and how to communicate the analysis and conclusions. The objective of financial analysis process, because of the variety of reasons for performing financial analysis, the numerous available techniques, and the often substantial amounts of data, it is important for analytical approach to be tailored at a specific situation. Prior to beginning any financial analysis, the analyst should clearly clarify the purpose of context and clarify understanding of the following. What is the purpose of the analysis? What questions will the analyst answer? What level of detail will be needed to accomplish these purpose? What data are available for the analysis? What are the factors or relationships that will influence the analysis? What are the analytical limitations, and what will these limitations potentially impair the analysis? Having clarified the purpose and context of the analysis, the analyst could select a set of techniques, e.g. ratios, that will best assist in making a decision. Although there is no single approach, the structure of analysis process, a general framework is set forth. Exhibit 1. The step in this process will be discussed in more detail in the earlier reading. The primary focus of reading is on phases 3 and 4, processing and analyzing data. Distinguishing between computation and analysis. An effective analysis encompasses both computation and interpretation. A well-reasoned analysis differs from a mere computation of various pieces of information, computation tables and graphs. By interpreting the data collected into a cohesive whole, analysis of past performance, for example, should address not only what happened, but also why it happened and whether it advances the company's strategy. Some of the key questions to address includes what aspects of performance are critical for the company to successfully compete in this industry. How well did the company's performance meet the critical aspects? What are key causes of this performance, and how does this performance reflect the company's strategy? If the analysis is forward-looking, additional questions include: what is the likely impact of an event or trend? What is the likely response of management to the trend? What is the likely impact of trends in the company, industry, and economy on future cash flows? What are the recommendations of an analyst? What risks should be highlighted? Example 1 demonstrates that a company's financial data can be analyzed in the context of its business strategy and changes in that strategy. The analyst must be able to understand the why behind the numbers and ratios, not just the numbers and ratios are. Analysts often need to communicate the findings of the analysis in a written report. Their reports should communicate how conclusions were reached and why communications were made. Recommendations were made. For example, a report might present the following: the purpose of the report, unless it is readily apparent. Relevant aspects of business context, economic environment, financial infrastructure, legal and regulatory environments. Evaluation of corporate governance and assessments of management strategies, includes the company's competitive advantages. Assessment of financial and operational data, including key assumptions in the analysis, and conclusions and recommendations, including limitations of the analysis and risks. An effective narrative and well-supported conclusions and recommendations are normally enhanced by 3 to 10 years of data, as well as analytical techniques appropriate to use the purpose of the report. Analytical tools and techniques. The tools and techniques presented in this section facilitates an evaluation of company data. Evaluation requires comparisons. It is difficult to say that a company's financial performance was good without clarifying the basis for comparison. In assessing a company's ability to generate and grow earnings and cash flow, the risk related to these earnings and cash flows, the analyst draws comparison to other companies, cross-sectional analysis, and over time, trend or time series analysis. For example, analysts may wish to compare the profitability of company competing in global industry. If the company differs significantly in size and or report, then their financial data is different currencies. Comparing the net income as reported is not useful. Ratios with expressed to one number in relation to another and common size financial statements can remove size as a factor and enable more relevant comparison. To achieve comparability across companies reporting in different countries, currencies, one approach is to translate all reported members into a common currency using exchange rates at the end of the period. Others may prefer to translate reported numbers using an average exchange rate during a period. Alternatively, it focuses on its primarily on ratios. Comparability and can be achieved without translating the currency. The analyst may also want to examine comparable performance over time. Again, the nominal currency amount on sales or net income may not highlight significant changes. However, using ratios, see example 2, horizontal financial statements where quantities are stated in terms of a selected base year value, and graphs can make sure changes more apparent. Another obstacle to comparisons is differences in fiscal years end. To achieve comparability, one approach is to develop trailing 12-month data, which will be described in a section below. Finally, it should be noted that differences in accounting standards can limit comparability. Section 3.1 describes the tools and techniques of ratio analysis in more detail. Section 3.2 to 3.4 describes other tools and techniques. Ratios. There are many relationships between financial accounts and between expected relationships and other points. And from one point in time to another, ratios are a useful way for expressing these relationships. Ratios express one quantity in relation to another. Extensive academic research has examined the importance of ratios in predicting stock returns or credit futures. This research has found that financial statement ratios are effective in selecting instruments and in predicting financial distress. Practitioners routinely use ratios to derive and communicate the values of companies and securities. Several aspects of ratio analysis are important to understand. First, the computed ratios is not the answer. The ratio is an indicator of some aspect of the company's performance, telling what happened but not why it happened. For example, an analyst might want to answer the question, which of the two companies was more profitable, and demonstrated the previous example. The net profit margin, which expresses the profit relative to revenue, can provide insight into that question. Net profit margins is calculated by dividing the net income by its revenue. Assume company A has 100,000 euros, and net income of company B is 200,000 euros of net income. Company B generates twice as much income as Company A, but was it more profitable? Assume further, Company A has 2 million of revenue and a net profit margin of 5%, and Company B has 6 million in revenue and thus a net profit margin of 3.33%. Expressing net income as a percentage of revenue clarifies this relationship further. For each 100 euros of revenue, Company A earns 5 euros in net income, whereas Company B only earns 3.33 for each $100 in revenue. So, we can now answer the question of which company was more profitable as a percentage. As percentage terms, Company A was more profitable as indicated by its higher net profit margins of 5%. Note that company A was more profitable despite the fact that company B reported higher absolute amounts of net income and revenue. However, the ratio by itself does not tell us why company A has a higher profit margin. Further analysis is required to determine the reasons. Company size sometimes confers economies of scale, and so absolute amounts of net income and revenue are useful in financial analysis. However, ratio reduces the effects of size, which enhances the comparisons between companies and over time. The second important aspect of ratio analysis is that differences in accounting policies can distort ratios, and a meaningful comparison may therefore involve adjustments of financial data. Third, not all ratios are necessarily relevant in a particular analysis. The ability to select a relevant ratio for ratio to answer the research question is an analytical skill. Finally, as with financial analysis in general, ratio analysis does not stop with computation. Interpretation of the results is essential. In practice, differences in ratio across time and across companies can be subtle. Interpretation is situation specific. The universe of ratios. There are no authoritative bodies specifying exact formulas for computing ratios or providing a standard comprehensive list of ratios. Formulas and even names of ratios are often differ from analyst to analyst or from database to database. The number of different ratios can be created and is practically limitless. There are, however, widely accepted ratios that have been found to be useful. Section 4 of this reading will focus primarily on these broad classes and commonly accepted definitions of key ratios. However, the analyst should be aware that different ratios may be used in practice, and that certain industries have unique ratio tailored to the characteristic of the industry. When faced with an unfamiliar ratio, the analyst can examine the underlying formula to gain insight on what the ratio is measuring. For example, consider the following ratio: operating income divided by total average total assets. Never having seen this ratio, the analyst might question whether the result of 12% is better than 18%. The answer could be found in the ratio itself. The numerator is operating income and denominator is average total assets. So the ratio can be interpreted as the amount of operating income generated per unit of assets. For every 100 euros of average total assets, generating 12 euros of operating income is better than generating 8 of the operating income. Furthermore, it's apparent that this particular ratio is an indicator of profitability. When facing a ratio for the first time, the analyst should evaluate the numerator and denominator to assess the ratio and attempt to ratio is attempting to measure and how it should be interpreted. To demonstrate in Exhibit 3. Operating income averages total assets ratios shown above is one of many versions of the returns on assets ROA ratio. Note that there are other ways of specifying this formula based on how assets are defined. Some financial ratio database computes ROA using the ending value of assets rather than the average assets. I'm pouring my green tea, by the way. Okay. So, returns on assets. Value, purpose, and limitations of ratio analysis. The value of ratio analysis is that it enables the financial analyst to evaluate past performances, assess the current financial positions of the company, and gain insight useful for projecting future results. As noted previously, the ratio itself is not the answer, but is an indicator of some aspect of a company's performance. Financial ratios provide insight into microeconomic relationship within a company that helps analysts project earnings and free cash flows. A company's financial flexibility or ability to obtain the cash required to grow and meet its obligations, even if unexpected circumstances develop. management ability, changes in a company and or industry over time, and comparability with peer companies or the relevant industries. There are also limitations to ratio analysis. Factors to consider include the heterogeneity of homogeneity of the company's operating activities. Companies may have divisions operating in many different industries. This can make it difficult to find comparable industry ratios to use for comparison purposes. The need to determine whether the results of the ratio analysis are consistent, the need to use judgment, the use of alternative accounting methods. The expanding of the IFRS and the coverage of the differences between IFRS and US GAAP have sought to make the financial statements of different companies more comparable and may overcome some of the difficulties. Nonetheless, there will remain accounting choices that the analyst must consider. Sources of ratios. Ratios may be computed using data obtained directly from companies' financial statements or from a database following Bloomberg's Computat, FactSet, and Thomson Reuters. The information provided by the database may include information as reported in companies' financial statements and ratios calculated based on the information. These databases are popular because they provide easy access to many years of historical data, so the trends over time can be examined. They also allow for ratio calculations based on time period other than a company's fiscal year, such as trailing 12 months or TTM, and to the most recent quarter, MRQ. Analysts should be aware that the underlying formulas for ratios may differ by vendor. The formula used should be obtained from vendors, and the analyst should determine whether any adjustments are necessary. Furthermore, database providers often exercise judgment on when classifying items. For example, operating income may not appear directly on a company's income sheet, and the vendors may use judgment to classify income statements into operating and non-operating. Variations in such judgments will affect any computation involving operating income. It is therefore a good practice to use the same source for data when comparing different companies or when evaluating the historical record of a single company. Analysts should verify the consistency of formulas and data classification by data sources. Analysts should be mindful of judgments made by vendors in data classification. And refer back to sources of financial statements until they are comfortable with the classifications are appropriate. Statements are underlying development that collects financial data for regulatory filings and can be automatically compute ratios. The extensible business report language, the EXB, the XBRL mechanism is a mechanism that attaches smart tags to financial information, e.g. total assets, so that software can automatically collect data and perform its desired computations. The organization developed XBRL as an international nonprofit consumers of over 600 members from companies, associations, and agencies, including the International Accounting Standard Board. Many stock exchanges and regulatory agencies around the world now use XBRL for receiving and distributing public financial reports and from listed companies. Analysts can compare Analysts can compare a subject company to similar peer companies in these databases or use aggregate industry data for nonprofit companies. Aggregate industry data can be obtained from such sources as annual statements studied by the Risk Management Association or Don broadsheets. These publications typically provides industry data with companies sorted into quartiles. By definition, 25% of company ratios falls within the lowest quartile, 25% ratios between the lower quartile and the medium valley, and so on. Analysts can then determine a company's relative standing in the industry. Common size analysis. Common size analysis involves expressing financial data, including entire financial statements, in relation to a single financial statement item or base. Items used most frequently are the bases, total assets or total revenue. In essence, common size analysis creates a ratio between every financial statement item and these base item. Common size analysis will demonstrate readings for the income statement, balance sheet, and cash flow statements. In this section, we present common size analysis of financial statements in greater detail and include further discussion of their interpretation. Common size analysis of the balance sheet. A vertical common size balance sheet prepared by dividing each item on the balance sheet by the same period's total assets and expressing the result as a percentage highlights the composition of the balance sheet. What is the mix of assets being used? How is the company's financing itself? How does one company's balance sheet composition compare with that of peer companies? What are the reasons for any differences? A horizontal common size balance sheet prepared by computing the increase or decrease in percentage terms of each balance sheet items from the prior year, or prepared by dividing the quantity of each item by a base year quantity of the item, highlights changes in items. These changes can compare to expectations. These sections on trend analysis below will illustrate a horizontal common size balance sheet. Example 3 presents a vertical common size or partial balance sheet for a hypothetical company in 2 time periods. In this example, receivables have increased from 35% to 57% of total assets, and the ratio has increased by 63% from period 1 to period 2. What are possible reasons for such an increase? The increase might indicate that the company is making more of its sales on a credible basis rather than a cash basis, perhaps in response to some action taken by a competitor. Alternatively, the increase in receivables as a percentage of assets may have occurred because of a change in other currencies asset category. For example, a decrease in the level of inventory. The analyst would then need to investigate why these asset categories have changed. Another possible reason for the increase in receivables as a percentage of assets is that the company has lowered its credit standard, relaxed collection procedures, or adopted more aggressive revenue recognition policies. The analyst can turn the other comparisons and ratios to help determine which explanation is most likely. Common size analysis of the income statement. A vertical common size income statement divides each statement item by revenue or sometimes by total assets. If there are multiple revenue sources, decomposition of revenue in percentage terms is useful. Exhibit 4 presents a hypothetical company's vertical common size income statement. In 2 time periods, revenue is separated into the company's 4 services, each shown as a percentage of total revenue. In this example, revenue from service A has become a far greater percentage of the company's total revenue, 30% in period 1, 45% in period 2. What are possible reasons for the implication of this change in business mix? Did the company make a strategic decision to sell more of service A, perhaps because it is more profitable? Apparently not, because the company's earnings before interest, taxes, depreciation, and amortization declined from 53% of sales to 45%, so other possible explanations should be examined. In addition, we note from composition of operating expense that the main reason for the decline in profitability is that the salaries and employee benefits has increased from 50% to 25% of total revenue. They are more highly compensated employees required for service A, or higher training costs incurred in order to increase revenue from service A. If the analyst wants to predict future performance, the causes of these changes must be understood. cross-sectional analysis, and as noted previously, ratios and common size statements derive part of their meaning through comparison to some benchmark, or cross-sectional analysis compares a specific metric for one company with the same metric for another company or a group of companies, allowing comparison even though the companies may be significantly different sizes and or operate in different of currencies. This is illustrated in Exhibit 5. Exhibit 5 presents a vertical common size or partial balance sheet for two hypothetical companies at the same point in time. Company 1 is clearly more liquid than Company 2, which has only 12% of assets available as cash, compared with the highly liquid Company 1, which has 38% of assets available in cash. Given the cash is generally a relatively low yielding asset and thus not a particularly efficient use of excess funds, why does Company 1 hold such a large percentage of total assets in cash? Perhaps the company is preparing for acquisition or maintains a large cash position as insulation from a particularly volatile operating environment. Another issue highlighted by the comparison is the relatively high percentage of receivables in Company 2's assets, which may indicate a greater proportion of credit sales, overall changes in asset composition, lower credit or collection standards, or aggressive accounting policies. Trend analysis: when looking at financial statements and ratios, trends in the data, whether they are improving or deteriorating, are as important as the current absolute or relative levels. Trend analysis provides important information regarding historical performance and growth, and given a sufficiently long history of accurate seasonal information, can be of great assistance as planning and forecasting tool for management and analysts. Exhibit 6A presents a partial balance sheet for a hypothetical company over 5 periods. The last 2 columns of the table shows the changes for period 5 compared to period 4, expressed both in absolute currency, in this case dollars, and the percentages. A small percentage change can hide a significant currency change, and vice versa, prompting the analyst to investigate the reasons despite one of the changes being relatively small. In this example, the largest percentage change was in investments, which decreased by 33.3%. However, an examination of this absolute currency amount of changes shown in the investment change by only 2 million, and the more significant changes was a 12 million increase in receivables. Another way to present data covering a period of time is to show each item in relation to the same item in a base year. Exhibit 6B and 6C illustrates alternative presentations of horizontal common size balance sheet. Exhibit 6B presents the information from the same partial balance sheet as in Exhibit 6A, but indexes each item relative to the same items in period 1. For example, in period 2, a company had 29 million cash, which is 74% or 0.74 of the amount of cash in period 1, expressed as an index in period 1 as such. Okay. An analyst of horizontal common size balance sheet highlights structural changes that have occurred in a business. Past trends are obviously not necessary as an accurate predictor of the future, especially when the economic or competitive environment changes. An examination of past trends is more valuable when the macroeconomic and competitive environments are relatively stable and when the analyst is reviewing a stable or mature business. However, even in less stable contexts, historical analysis can serve as a basis for developing expectations. Understanding the past trends is helpful in assessing whether these trends are likely to continue or if they are likely to change directions. One measure of success is for a company to grow at a rate greater than the rate of the overall market in which it operates. Companies that grow slowly may find themselves unable to attract quantity quantity capital. Conversely, companies that grow too quickly may find that their administrative and management information systems cannot keep up with the rate of expansion. Relationship among financial statements. Trend data generated by horizontal common size analysis can be compared across financial statements. For example, the growth rate of a set of assets for the hypothetical company in Exhibit 6 can be compared with the company's growth in revenue over the same period of time. If revenue is growing more quickly than assets, then the company may increase its efficiency. As another example, consider the following year-over-year percentage changes of a hypothetical company. Net income is growing faster than net revenue, which indicates increasing profitability. However, the analyst would need to determine whether the faster growth in net income resulting from continuing operations or from non-operating, non-recurring items. In addition, the 10% decline in operating cash flows despite increasing revenue and net income clearly warrants a further investigation because it could indicate a problem with earning quantity. Lastly, the fact that assets have grown faster than revenue indicates the company's efficiency may be declining. The analyst should examine the composition of the increases The use of graphs as an analytical tool. Graphs facilitate comparison of performance and financial structure over time, highlighting changes in significant aspects of business operations. In addition, graphs with a visually overview of risk trends in a business, graphs may also be used effectively to communicate the analyst's conclusions regarding financial conditions and risk management aspects. Exhibit 7 presents the information for Exhibit 6A in a stacked column format. The graph makes the significant decline in cash and growth in receivables, both in absolute terms and percentage of assets, readily apparent. Exhibit 7, the vertical axis shows US dollars in millions, and the horizontal axis shows the notes of the period. Choosing the appropriate graph to communicate the most significant conclusions of the financial analysis analysis is a skill. In general, pie graphs are most useful to communicate composition of total value. Line graphs are useful to focus on the changes in amount for a limited number of items over a relatively long time period. When the composition and amounts as well as their changes over time are all important, a stacked column graph can be useful. Okay. When comparing period 5 with period 4, the growth in receivables appears to be within normal bounds. But when comparing period 5 with earlier periods, the dramatic growth becomes apparent. In the same manner, a simple line graph will also illustrate the growth trends in key financial variables. Exhibit 8 presents the information from Exhibit 6A as a line graph, illustrating the growth of assets as a hypothetical company over 5 periods. The steady decline in cash, volatile movements of inventory, and dramatic growth in receivables is clearly illustrated. Again, the vertical axis is shown in US dollar millions, and horizontal axis denotes the period. Regression analysis. When analyzing a trend in specific line items or ratios, frequently it is possible simply to visually evaluate the changes. For more complex situations, regression analysis can help identify relationships or correlations between variables. For example, a regression analysis can relate a company's sales to GDP over time, providing insight into whether the company is cyclical. In addition, the statistical relationship between sales and GDP can be used as a basis for forecasting sales. Other examples, otros ejemplos of this relationship between the company's sales and inventory over time, or the relationship between hotel occupancy and company's hotel revenue. In addition to providing a basis for forecasting, regression analysis facilitates identification of items or ratios that are not behaving as expected given historical statistical relationships. Common ratios used in financial analysis. In the previous section, we focused on ratios resulting from common sense analysis. In this section, we expand the discussion to include other commonly used financial ratios on the broad classes into which they are categorized. There is some overlap with common size financial statement ratios. For example, a common indicator of profitability is the net profit margin, which is calculated as the net income divided by sales. The ratio appears on a vertical common size income statement. Other ratios involve information from multiple financial statements or even data from outside the financial statement. Because of the large number of ratios, it is helpful to think about ratios in terms of broad categories based on what aspects of performance a ratio is intended to direct. Financial analysts and data vendors use a variety of categories to classify ratios. The category includes activity, liquidity, solvency, profitability, and valuation. The categories are summarized in Exhibit 9. Each category measures a different aspect of the company's business, but are all useful in evaluating a company's overall ability to generate cash flow from operating the business and associated risks. The categories are not mutually exclusive. Some ratios are useful in measuring multiple aspects of the business. For example, an activity ratio measures how quickly a company collects accounts receivables. Is also useful in assessing a company's liquidity because collection of revenue increases cash. Some profitability ratios also reflect the operating efficiency of the business. In summary, analysts appropriately use certain ratios to evaluate multiple aspects of the business. Analysts needs to be aware of variations in industry practices and the calculations of financial ratios. In the text that follows, alternative views on ratio calculations are often provided. Interpretation and context. Financial ratios can only be interpreted in the context of other information, including benchmarks. In general, the financial ratios of a company are generated with these of the major competitors, cross-sectional and trend analysis. And to the company's prior period trend analysis, the goal is to understand the underlying causes of divergence between a company's ratio and those of the industry. Even ratios that remain consistent require understanding because consistency can sometimes indicate accounting policy selected to smooth earnings. An analyst should evaluate financial ratios based on the following company goals and strategies. Industry norms and economic conditions. Activity ratios, also known as asset utilization ratios or operating efficiency ratios. This category is intended to measure how well a company manages various activities, particularly how efficiently it manages its various assets. Activity ratios are analyzed as indicators of ongoing operational performance, how effective assets are used by companies. These ratios reflect the efficient management of both working capital and long-term assets. As noted, efficiency has a direct impact on liquidity, the ability of a company to meet its short-term obligations. So some activity ratios are also useful in assessing liquidity. Calculations of activity ratios. Exhibit 10 presents the most commonly used activity ratio. The exhibit shows the numerator and denominator of each ratio. Activity ratios measures how efficiently the company utilizes assets. They generally combine information from the income statement in the numerator with the balance sheet item as in the denominator, because the income statement measures what happens during a period, whereas the balance sheet shows the conditions only at the end of the period. Average balance sheet data are normally used for consistency. For example, to measure inventory management efficiency, cost of sales for cost of goods sold is divided by the average inventory. Most databases, such as the Bloomberg and Baseline, are use the averaging convention when income statements and balance sheet data are combined. These databases typically average only 2 points, the beginning of the year and the end of this year. The examples that follow based on annual finance statements illustrates that practice. However, some analysts prefer to average more observations if they are available, especially if the business is seasonal. If a semi-annual report is prepared, an average can be taken over 3 data points, beginning, middle, and end of the year. If quarterly data were taken, 5 points can be computed, beginning of the year, end of each quarterly period, and end of each quarterly period. For 4 point, so this is quite self-explanatory. Because cost of goods sold measures the cost of inventory that have been sold. This ratio measures how many times per year can the entire inventory was theoretically turned over or sold. If, for example, a company's cost of goods sold for a recent year was 120,000 euros, and its average inventory was 10,000 euros, and the inventory turnover ratio would then be 12. The company theoretically turns over, i.e. sells its inventory 12 times per year, i.e. once per month. Again, we say theoretical because in practice, companies are likely carriers. Some inventory from months for 1 month into another. Turnover can also be converted into days inventory on hand, or DOH, or duh, by dividing inventory turnover into a number of days of the accounting period. Activity ratios can be computed for annual or interim periods. But care most be taken in the interpretation of the comparison across periods. For example, if some company has had cost of goods for goods sold for the first quarter or 90 days of the following year of the 35,000 of the average inventory of 11,000, the inventory turnover would be 3.18 times. However, this turnover rate is 3.18 times per quarter, which is not directly comparable with its 12 times per year and in the preceding year. In this case, we can annualize the quarterly inventory turnover rate by multiplying the quarterly turnover by 4. For comparison to the annual turnover rate, so the quarterly inventory turnover is equivalent to 12.72 annual turnover rate, so the quarterly inventory turnover is equivalent to 12.72 annual inventory turnover. To compute the DOH using quarterly data, we can use the quarterly turnover rate and the number of days in the quarter for the numerator, or we can use the annualized turnover rate for 365 days. Either results a DOH of around 28.3 with slight differences due to rounding. Another time-related computation detail is that for companies using a 52/53 week annual period, and for leap years, the actual days of the year should be used rather than 365. In some cases, the analyst may want to know how many days of inventory are on the hand each year rather than on average of each year. In this case, it would be appropriate to use year-end inventory balance and compare and computation rather than the average. If a company is growing rapidly or if its cost is increasing, rather than the average. Yeah, that makes sense. Interpretation of activity ratios. Inventory turnover of DOH. Inventory turnover lies at the heart of operations for many entities, and it indicates the resources tied up in inventory and can therefore be used to indicate inventory management effectiveness. A higher inventory turnover ratio implies a shorter period of that the inventory is held, and thus a lower DOH in general. Inventory turnover and DOH should be benchmarked against industry norms. A high inventory turnover ratio relative to industry norms might indicate highly effective inventory management. Alternatively, a high inventory turnover ratio and commensurately low DOH can potentially indicate a company does not carry adequate inventory, or shortages can potentially hurt revenue. To assess which explanation is more likely. The analyst can compare the company's revenue growth with that of an industry. Slower growth combined with higher inventory turnover can indicate inadequate inventory levels. Revenue growth at or above the industry's growth supports the interpretation of the higher turnover reflects greater inventory management efficiency. A low inventory turnover ratio and commensurately high DOH relative to the result of the industry can have an indicator of slow-moving inventory, perhaps due to technological obsolescence of the change in fashion. Again, comparing the company's sales growth with this industry can offer insight. Receivables, turnover, and DSO. The number of DSO represents the elapsed time between sale and cash collected, reflecting how fast the company collects cash from consumers to whom it offers credit. Although limiting the numerator to sales made on credit and revenue turnover would be more appropriate, credit sales information is not always available to analysts. Therefore, revenue as reported in income statements is generally used as an approximation. A relatively high receivable turnover ratio might indicate highly efficient credit and collection. Alternatively, high receivable turnover ratios can indicate the company's credit or collection policies are too stringent, suggesting that possibility of sales being lost to competitors offering more lenient terms. A relatively low receivable turnover ratio would typically raise questions about the efficiency of a company's credit and collection procedures. As with inventory management, comparisons of the company's sales growth relative to industry can help analysts assess whether sales are being lost due to the stringent credit policies. In addition, comparing the company's estimates of collectible account receivables and actual credit losses with past experiences and with peer companies can help assess whether low turnovers reflect credit management issues. Companies often provide details of receivable aging, how much receivables have been outstanding by age. This can be used along with DSO to understand trends in collection, as demonstrated in example 7. Okay. Payable turnovers of the number of days of payables. The number of days of payables reflect an average number of days companies take pay its suppliers, and payables turnover ratios measure how many times per year the company theoretically pays off its creditors. For purposes of calculating these ratios, an implicit assumption is that the company makes all its purchases using credit. If the amount of purchase is not directly available, it can be computed as cost of goods sold plus ending inventory less beginning inventory. Alternatively, cost of goods sold is sometimes used as an approximation of purchases. Payables turnover ratios that is high relative to the industry can indicate that the company is not making full use of available credit facilities. Alternatively, it can result from a company's taking advantage of early payment discounts. An excessive low turnover ratio can indicate trouble making payments on time, or alternatively, exploitation of lenient supplier terms. This is another example where it is useful to look simultaneously at other ratios. If liquidity ratios indicate that the company has significant cash and other short-term assets to pay obligations, and yet the days payable ratios is relatively high, the analyst would favor the lenient supplier credit and collection policies as an explanation. Working capital turnovers. Working capital is defined as current assets minus current liabilities. Working capital turnovers indicates how effectively the company generates revenue with its working capital. For example, a working capital turnover ratio of 4.0 indicates the company generates 4 euros for every 1 euro of working capital. A high working capital turnover ratio indicates greater efficiency. For some companies, working capital can be near zero or negative, rendering the ratio incompatible of being interpreted. The following two ratios are most useful in the circumstances: fixed asset turnover and total asset turnover. Liquidity ratios. Liquidity analysis, which forecasts on cash flows, measures a company's ability to meet its short-term obligations. Liquidity measures on the quickness assets are converted into cash. Liquidity ratios are also measures the ability to pay off short-term obligations in day-to-day operations. Liquidity management is typically achieved through efficient use of assets. In the medium term, liquidity is the non-financial sector. Is also addressed by managing the structure of liabilities. The level of liquidity needed differs from one industry to another. A particular company's liquidity position may vary according to the anticipated need to fund at any given time. Judging whether a company has adequate liquidity requires analysis of its historical funding requirements, current liability positions, anticipated future funding needs, and options for reducing funding needs or attracting additional funds. Larger companies are usually better able to control the level of composition of the liabilities than smaller companies. Therefore, they may have more potential funding sources, including public capital and money markets, greater discretionary access to capital markets, and also reduces the size of the liquidity buffer needed relative to the companies without such access. Contingent liabilities such as letter of credit or financial guarantees can also be relevant when assessing liquidity. The importance of contingent liabilities varies for the non-banking and banking sector. In the banking sector, contingent liabilities and non-banking and banking sectors. In the non-banking sector, contingent liabilities usually disclosed in the footnote of the company's financial statement represents potential cash outflows, and when appropriate, should be included in the assessment of a company's liquidity. In the banking sector, contingent liabilities represent the potentially significant cash outflows that are not dependent on the bank's financial conditions. Although outflows in normal market circumstances typically may be low, a general macroeconomic or market crisis can trigger a substantial increase in cash outflows related to contingent liabilities because of the increase in defaults and business bankruptcies that often accompany such events. In addition, such crises can usually characterized by diminished levels of overall liquidity, which can further exacerbate funding shortfalls. Therefore, for the banking sector, the effects of contingent liabilities on liquidity warrants particular action. Calculation of liquidity ratios. Common liquidity ratios are presented in Exhibit 12. These liquidity ratios reflect a company's position at the point of time and therefore typically use data for the ending balance sheet rather than averages. The current quick and cash ratio reflects three measures of a company's ability to pay current liabilities. Each uses a progressively stricter definition of liquid assets. The defensive interval ratio measures how long a company can pay its daily cash expenditure using only its existing liquid assets without additional cash flows coming in. The ratio is similar to the burn rate, often computed for start-up interest companies in the late 1990s. For the biotechnology companies, the numerator of this ratio can includes the same liquid assets used in the quick ratio, and the denominator is the cash expenditures for a period divided by the numerator of days in the period. Total cash expenditures for the period can approximate the cash conversion cycle. A financial matrix, not ratio form, measures the length of the time required for a company to go from cash paid, usually in its operations, to cash achieved. The cash conversion cycle is sometimes expressed as the length of time that funds are tied up in working capital during the period of time the company needs to finance its investments in operations through other sources, i.e. through debt or equity. Interpretation of liquidity ratios. Common current ratios. This ratio expresses current assets in relation to current liabilities. A higher ratio indicates higher levels of liquidity. A current ratio of 1 would indicate that the book value of its current assets exactly equals the book value of its current liabilities. The lower ratio indicates less liquidity, implying a greater reliance on operating cash flows and outside financing to meet short-term obligations. Liquidity affects the company's capacity to take on debt. The current ratio implicitly assumes that inventories and account receivables are indeed liquid. Quick ratios. The quick ratio is more conservative than the current ratio because it includes only the most liquid current assets. In relation to the current liabilities, like the current asset, a higher quick ratio indicates greater liquidity. The quick ratio reflects the fact that certain current assets, such as prepaid expenses, such as taxes and employee-related payments, represent cash on the current period, but are prepaid for the advances that cannot be converted back into cash. This ratio also reflects the fact that inventory might not easily and quickly convert it into cash. And furthermore, that the company would probably not be able to sell all the inventory in the amount equal to the carrying value, especially if they were required to sell the inventory quickly. In situations where inventories are liquid, the quick ratio may be a better indicator of the liquidity than the current ratio. The cash ratios normally represent a reliable measure for an entity's liquidity in the crisis situations. On a highly marketable short-term investment, the cash are included in a general market condition. In a general market crisis, the fair value of marketable securities could decrease significantly as a result of market factors, in which case even its ratios might not provide reliable information. Defensive interval ratios. The ratio measure how long the company can continue to pay its expenses from its existing liquid assets without receiving any additional cash inflows. A defensive interval ratio of 50 will indicate that the company can continue to pay its operating expenses for 50 days before running out of quick assets. Assuming no additional cash inflows, a higher defensive interval ratio indicates greater liquidity. If a company's defensive interval ratio is very low relative to peer companies or to the company's own history, the analyst would want to ascertain whether there is sufficient cash inflows expected to mitigate the low defensive interval ratios. Cash conversion cycles, not operating cycles. The metric indicates the amount of time that elapsed from the point when a company invests in working capital until the point at which the company collects its cash. In the typical course of events, a merchandising company acquires inventory on credit and current account payables. Afterwards, it pays out cash to settle the accounts payable, and collects cash and settlements of its accounts receivables. The time between the outlay of cash and the collection of cash is called the cash conversion cycle, or shorter cash conversion cycle indicates greater liquidity. Short cash conversion cycles implies that the company only needs to finance its inventory and accounts receivables for a short period of time. A longer cash conversion cycle indicates lower liquidity. It implies that the company must finance its inventory and accounts receivables for longer periods of time, possibly indicating a need for a higher level of capital or funding current assets. Example 9 demonstrates the advantages of short-term conversion cycles, as well as how a company's business strategies are reflected in financial ratios. Solvency ratio. Solvency refers to a company's ability to fulfill long-term debt obligations. Assessments of a company's ability to pay its long-run obligations, i.e. make interest and principal payments, generally includes an in-depth analysis of a component of its financial structure. Solvency ratios provides information regarding the relative amount of debt in a company's capital structure and the adequacy of earnings and cash flows to cover interest expenses and other fixed charges. And as they come due, analysts seek to understand a company's use of debt for several main reasons. One reason is that the amount of debt in a company's capital structure is important for assessing a company's risk and return characteristics. Specifically, it's financial leverage. Leverage is a magnifying effect that results from the use of fixed costs that stay the same within some range of activity, and can take two forms: operating leverage and financial leverage. Operating leverage results from use of fixed costs is conducting the company's business. Operating leverage magnifies the effect of changes in sales and operating income. Profitable companies may use operating leverage because when revenues increase with operating leverage, their operating income increases at a faster rate. The explanation is that although variable costs will rise proportionally with revenue, fixed costs will not. When financing a company, the use of debt constitutes financial leverage because investment interest payments are essentially fixed financing costs. A result of interest payments, a given percentage change of EBIT results in a lower percent change in the earnings before tax, or EBT. Thus, financial leverage tends to magnify the effects of changes in EBT. Our returns falling on equity holders. Assuming that a company can earn more on funds than it pays in interest, the inclusion of some level of debt in a company's capital structure may lower a company's overall cost of capital and increase returns on equity holders. However, a higher level of debt in a company's capital structure increases the risk of default and results in higher borrowing costs. For a company compensates lenders for assuming greater credit risk, starting with M&M. A substantial amount of research has focused on determining a company's optimal capital structure, and the subject remains important in corporate finance. In analyzing financial statements, an analyst aims to understand levels and trends in a company's use of financial leverage in relation to past practices and practices of peer companies. Analysts also needs to be aware of the relationship between operating leverage and financial leverage. The greater the company's operating leverage, the greater risk of operating income streams available to cover debt payments. Operating leverage can thus limit a company's capacity to use financial leverage. A company's relative solvency is fundamental in valuation of its debt securities and its creditworthiness. Finally, understanding a company's use of debt can provide analysts with insight into the company's future business prospects. Because management's decisions about financing may signal their beliefs about a company's future. For example, the issuing of long-term debt repurchases common shares may indicate the management believes the market is underestimating a company's prospects and the shares are undervalued. Solvency ratios are primarily the two types of debt ratios. Debt ratios. The first type focuses on balance sheets and measures the amount of debt capital relative to equity capital. Converge ratios. The second type focuses on income statements and measures the ability of a company to cover its debt payments. These ratios are useful in assessing a company's solvency and therefore in evaluating the quality of companies' bonds and other debt obligations. Interpretation of solvency ratios. In the following, we discussed the interpretation of the basic solvency ratio presented in Exhibit 14. Debt to asset ratios, debt to capital ratios, debt to equity ratios, finance leverage ratios, interest convergence, fixed charge convergence, or fixed charge coverage. Yeah. As with all ratio analysis, it is important to consider leverage ratios in a broader context. In general, companies with lower business risk and operations will generate steady cash flows, are better positioned to take on more leverage without a commensurate increase in the risk of insolvency. In other words, a higher proportion of debt financing poses less risk of non-payment of interest and debt principal to a company with steady cash flows than to a company with a volatile cash flows. Profitability ratios, the ability to generate profit on capital invested is a key determinant of a company's overall value and value of the securities it issues. Consequently, many equity analysts will consider profitability to be a key focus of an analytical effort Profitability reflects a company's competitive positions in the market and by extension the quality of its management. The income statement reveals the source of earnings and the components of revenue and expenses. Earnings can be distributed to shareholders or reinvested into the company. Reinvested earnings enhances solvency and provides a cushion against short-term problems. Calculations for profitability ratios. Profitability ratios measures the returns earned from a company during a period. Exhibit 15 provides the definition of selection of commonly used profitability ratios. Returns on sales profitability ratios express various subtotals and an income statement as a percentage of the revenue, especially these ratios constitute part of a common-size income statement discussed earlier, or total capital employed by the company for operating ROA. Returns on measured as operating income, i.e. prior to deducting interest on debt capital for ROA. The ROE returns on measured on income, i.e. deducting interest paid on debt capital for returns on common equity. Returns are measured as net income minus preferred dividends. Interpretation of profitability ratios. The gross profit margin. The gross profit margin indicates the percentage of revenue available for cover operations and other expenses and general profit. Higher gross profit margins indicates that a combination of higher product pricing and lower product costs. The ability to charge higher prices is contained in competition. Gross profit are affected by and usually inversely related to competition. If a product has a competitive advantage, e.g. superior branding, better quality, the company is better able to charge more for it. On the other side, higher gross profit margins can also indicate that the company has a competitive advantage in production cost. Operating profit margins. Operating profit is calculated as gross profit minus operating costs. So an operating profit margin increases faster than the gross profit margins can indicate improvements in controlling operating costs, such as administrative overheads. In contrast, a declining operating profit margins can be an indicator of deteriorating controls over operating costs. Pre-tax margins. Pre-tax income is calculated as operating profit minus interest, and the pre-tax margin is the ratio of pre-tax income to revenue. The pre-tax margin reflects the effects of profitability, of leverage, and other income and expenses. If a company pre-tax margins is increasingly primarily as a result of increasing amount of non-operating income, the analyst should evaluate whether this increase reflects a deliberate change in the company's business focus and therefore the likelihood that the increase will continue. Net profit margins. Net profit margins or net income is calculated as revenue minus all expenses. Net income includes both recurring and non-recurring components. Generally, the net income used in calculating the net profit margin is adjusted to reflect non-recurring items to offer a better view of the company's potential profitability. ROA measures the return earned by the company on its assets. The higher the ratio, the more income is generated by the given level of assets. More database computes the ratio, net income divided by total, the average total assets. An issue with this computation is that net income is the return on equity holders, whereas assets are financed by both equity holders and creditors. Interest expense has already been subtracted by the numerator. Some analysts therefore prefer to add back the interest expense in the numerator. In such cases, interest must be adjusted for income taxes before net income is determined after tax. So if this adjustment, the ratio is as such. Okay. Integrated financial ratio analysis. The prior sections, the text presented separately activities, liquidity, solvency, or profitability ratios. Prior to discussing valuation ratios, the following section demonstrates the importance of examining a variety of financial ratios. Not a single ratio of category of ratios is in isolation. To ascertain the overall position and performance of a company, experiences shown that the information from one ratio category can be helpful in answering questions raised by another category, and that the most accurate overall picture comes from integrating information from all sources. Section 4.6.1 provides some indicatory examples of such analysis, and Section 4.6.2 shows how returns on equity can be analyzed into components related to profit margins, asset utilization activity, and financial leverage. The overall ratio picture examples. Okay. Okay, so here's just the analysis of the example. That's my brother playing the cajon there. He's trying to learn how to drum. You want to hear? He's just a beginner at it. I also did 3 years of drumming. Okay. Equity analysis. Okay, we will pause our reading on equity analysis. Let me see how much more on this chapter we have. Okay, we have quite a bit. So I think we will pause on equity analysis. Actually, you know what? Let's finish this. Let's go back to 1667. Let's finish this whole reading. Okay? To 1680. Equity analysis, one application of financial analysis, is to select securities as part of the equity portfolio management process. The analysts are interested in valuing a security to assess its merits and for inclusion of retention of its portfolio. The valuation process has several steps, including understanding a business and existing financial profile, forecasting the company's performance. Selecting forecasts of evaluation, making an investment decision. Financial analysts assist in providing the core information to complete the first two steps of its valuation process. Understanding the business and forecasting performance. Fundamental equity analysis involves evaluating a company's performance and valuing its equity in order to assess its relative attractiveness of as an investment. Analysts use a variety of methods to value a company's equity, including valuation ratios, e.g. the price to earnings or PE ratios, discounted cash flow approaches, and residual income approaches, ROE, compared with the cost of capital, among others. The section addresses the first of these approaches, the valuation ratio. The valuation ratios have long been used in investment decision making as well-known examples of a price to earnings ratio. Probably the most widely cited indicator of discussion of a value of equity securities, which relates to share price and earnings per share, additionally, or EPS. Additionally, some analysts used other market multiples, such as price to book ratio, the PB, or the price to cash flow ratio, the P to CF ratio. The following section explores valuation ratios and other quantities related to valuing quantities. Calculation and valuations of ratios and related quantities. Because PE ratios are calculated using net income, the ratio can be sensitive to non-recurring earnings and one-time earning events. In addition, because net income is generally considered to be more susceptible to manipulation, then the cash flow analysts may use price to cash flows as an alternative measure. Particularly in situations where earnings quantities may be an issue. ITDA per share, because of its calculated using income before interest, taxes, and depreciation, can be used to eliminate the effects of different levels of fixed asset investment across companies and facilitates comparisons between companies in the same sector, but at different stages of infrastructure maturity. Price to sell calculated in a similar manner, and is sometimes used as a comparative price metric when a company does not have positive net income. Another price-based ratio that facilitates useful comparison of companies' stock price and price to book value, the PB ratio, which is the ratio to the book value of per share. This ratio is often interpreted as an indicator of market judgment about the relationship between a company requires rate of returns and its actual rate of return, assuming that book value reflects the fair value of the asset. The price of the book ratio of 1 can be interpreted as the indicator of the company's future returns as expected to be exactly equal to the returns required by the market. A ratio greater than 1 would indicate that the future profitability of the company is expected to exceed the required rate of return. The value of its ratio less than 1 indicates that the company is not expected to earn excess returns. Interpretation of earnings per share. Exhibit 18 presented a number of per share quantities that can be used in the valuation of ratios. In this section, we discuss the interpretation of such critical quantities, earnings per share or EPS. EPS is simply the amount of earnings attributed to each share of common stock in isolation. EPS does not provide adequate information about the comparison of company with another. For example, assuming 2 companies have only common stock outstanding and non-dilutive securities outstanding. In addition, assuming that 2 companies have identical net income of 10 million, identical book equity of 100 million, and therefore identical profitability, 10% using ending quantities can cause for simplicity. Furthermore, assume that company A has 100 million weighted average common share outstanding, where company B has 10 million weighted average common shares. So this is quite straightforward, just EPS. Dividend related quantities. In this section, we discussed the interpretation of the dividend related quantity presented in section 18. This quantity plays a role in some present value models for valuing equities. Dividend payout ratio. The dividend payout ratio measures the percentage earnings of the company's payout as dividends to shareholders. The amount of dividends per share tends to be relatively fixed because any reduction and dividends has been shown to result in disproportionately large reduction in share prices. Because dividend amounts are relatively fixed, the dividend payout ratio tends to fluctuate with earnings. Therefore, conclusions about a company's dividend payout policies should be based on examination of payouts over a number of periods. Optimal dividend policy, similar to optimal capital structure, can be examined in academic research and continues to be a topic of significant interest in corporate finance. The retention rate or earnings retention rate is the complement of the payout ratio for divided payout ratios, whereas the payment ratio measures the percentage of earnings of a company's pays out of dividends. The retention ratio is the percentage earnings that a company retains. Sustainable growth rate. A company's sustainable growth rate is viewed as a function of the profitability and its ability to finance itself for internally generated funds. This sustainable growth rate of ROE times the retention rate. A high ROE and a higher retention rate results in a higher sustainable growth rate. The calculation can be used to estimate a company's growth rates, a factor commonly used in equity valuation. Industry-specific ratios, as stated earlier in this reading, a universally accepted definition and classification of a ratio does not exist. The purpose of ratios is to serve as an indicator of important aspects of a company's performance and value. Aspects of performance that are considered important in one industry may be irrelevant in another. The industry-specific ratio reflects these differences. For example, companies in the retail industry may report some store sales changing because in the retail industry it is important to distinguish between growth and results from opening new stores and growth that results from generating more sales in existing stores. Industry-specific matrix can be specifically important to the value of equity in early stage industry where companies are not yet profitable. In addition, regulated industries, especially in the financial sector, often are required to comply with significant regulatory ratios. For example, the banking sector's liquidity and cash reserve ratios provides an indication of banking liquidity and reflects the monitoring and regulatory requirements. Banking capital requires adequacy requires attempts to relate banks' solvency requirements directly to the specific levels of risk exposure. Exhibit 9 presents, for illustrative purposes only, some industry-specific and task-specific ratios. Research on ratios and equity analysis. Some ratios may be particularly useful in equity analysis. The end product of equity analysis is often valuation and investment recommendation. Theoretical valuation models can be useful in selecting ratios that would be useful in the process. For examples, a company PB is theoretically linked to the ROE growth and required returns. ROE is also primarily determined of a residual income of a residual income valuation model. In both cases, higher ROE relative to the required return rate denotes a higher valuation. Similarly, profit margins is related to the to justify price to sell PS ratios under the common valuation method involves forecasts of future cash flows that are earnings of cash flows. Future growth expected are a key component of all of these valuation models. Trends may be useful in assessing growth prospects. The availability of ratios and common size data can be useful in assessing risk and important components of the required rate of return in valuation models. A great deal of academic research has focused on the use of these fundamental ratios. In evaluating equity investments, the classic study Pudman found the ratios and common size metric generated from accounting data was useful in forecasting earnings and stock returns. Pullman found 68 such metrics and found that it could be reduced to more parsimonious list of relevant variables. Credit analysis. Credit analysis is the risk of loss caused by counterparties or debtors' failures to make a promised payment. For example, credit risk with respect to a bond is a risk that the obligator is not able to pay interest and principal according to the terms of the bond indenture or the contract. Credit analysis is evaluation of credit risk. Approaches to credit analysis vary, and as with financial analysis, depends on the purpose of analysis and the context in which it is done. Credit analysis for specific types of debt, whereas the equity analysis may discount projects' cash flows to determine the value of components' equity. A credit analyst would use the projected cash flow to assess the likelihood of a company's comply with its financial covenants. In each period, the paying interest as our principal is due. The analyst would also include expectations about asset sales and refinancing options open to the company. Credit analysis may relate to borrower's credit risk in a particular transaction or in the overall credit worthiness. In assessing overall credit worthiness, one general approach is credit scoring, a statistical analysis of the determinants of credit defaults. Another general approach to credit analysis is the credit rating process that is used, for example, a credit rating agency to assess and communicate the profitability for default for an issuer on its debt obligations. A credit rating can be either long-term or short-term and an indication of a rating agency's opinions and creditworthiness of the debt issuers with respect to a specific debt securities or other obligation. When a company has no outstanding rating agency can also provide an issuer credit rating for expresses an opinion of issuer's overall capacity and willingness to meet financial obligations. The following section reviews research on the use of ratios in credit analysis and the ratio commonly used in credit analysis. The credit rating process. The rating process involves both analysis of a company's financial report as well as a broad assessment of a company's operations. The credit evaluation process by any analyst includes many of the following procedures performed by analytical credit rating agencies. Meeting with management typically includes the chief financial officer to discuss, for example, industry outlooks, overview of major business segments, financial positions and goals, tours of major facilities, time permitting, meeting of a rating committee where the analyst recommendation of a voted on after considering factors that includes business risk, operating environment, industry characteristics, success factors of areas of vulnerability, company's competitive position, financial risks includes the following, and monitoring the publicity distribution rating. In assessing credit rating, rating agencies emphasize the importance of the relationship between a company's business risk profile and its financial risks. The company's business risk profile determines the level of financial risk appropriate for any rating category. When analyzing financial ratios, rating agencies normally investigate the deviations of ratios from the median ratio, and the universe of the companies of which such ratios have been calculated are also used in the median rating as an indicator of the rating grade given to a specific debt issuer. This so-called universe of rated companies changes constantly, and any calculations are obviously affected by economic factors as well as by mergers and acquisitions. International rating includes the influence of country and economic risk factors. Exhibit 12 presents a key financial ratios used by Standard & Poor's and evaluating industry companies. Note that before calculating ratios, rating agencies make certain adjustments to report financial, such as adjusting debt to include off-balance sheets in the company's total debt. Research on ratios in credit analysis, business and geographic segments, and then model building and forecasting. Analysts often need to forecast future financial performance. For example, EPS forecasts of analysts are widely followed by Wall Street. Analysts use data about the economy, industry, and company in arriving at a company's forecast. The result of an analyst's financial analysis, including common size and ratio analysis, and integral to the process, along with judgment of the analysis based upon the forecast of growth and expected relationships among the financial segment data. The analyst can build a model, sometimes referred to as an earnings model, to forecast future performance. In addition to budgets, pro forma financial segments are widely used in the financial forecasting within companies, especially for use by senior executives and board directors. Last but not least, these badges and forecasts tools are used in presentation to credit analysts and others to obtain the external financing. For example, based on revenue forecasts, an analyst may budget expenses based on expected common size difference. Forecasts on balance sheets cash flows segments can be derived from expected ratio data such as DSOs. Forecasts cannot be limited to a single point estimate, but should involve a range of possibilities. This can involve several techniques: sensitivity analysis, scenario analysis, simulation. Okay, a summary. Phew, my reading session is 1.5 hours. I have sat in this chair reading CFA level 1, reading 26, and drinking my green tea. I've been here for half an hour, or 1.5 hour already. I'm glad to see the word summary. Summary of financial analyst techniques includes common size and ratio analysis. Are useful in summarizing financial reporting data and evaluating the performance and financial positions of a company. These results of financial analysis techniques provides important inputs into security evaluations. Key facets of financial analysis include the following: common size financial statements and financial ratios remove the effects of size, allowing comparisons of a company with peer companies, the comparisons of a company's results over time. Activity ratios measures the efficiency of a company's operations, such as collection of receivables or management inventory. Major activity ratios includes inventory turnover, days of inventory on hand, receivable turnovers and days of sales outstanding, payable turnovers, numbers of days of payables, working capital turnovers, fixed asset turnovers, and total asset turnovers. Liquidity ratios measures the ability of a company to meet short-term obligations. Majority liquidity ratios includes the current ratio, quick ratio, cash ratio, and defensive interval ratio. Solvency ratio measures the ability of a company to meet long-term obligations. Major solvency ratios include debt ratios, including the debt to asset ratio, debt to capital ratio, debt to equity ratio, finance leverage ratio, and convergence ratio. Profitability ratio measures the ability of a company to meet long-term obligations. Major solvency ratios include debt ratios, debt to capital ratios, and the coverage ratio. Profitability ratios measures the ability of a company to generate profits from revenues and assets. Major profitability ratios include returns on sales ratios, including gross profit margins, operating profit margins, pre-tax margins, and net profit margins. The returns on investment ratios. Ratios can also be combined and evaluated as a group to better understand how they fit together and how efficiency and leverage are tied to profitability. ROE can be analyzed as a product and a net profit margin, asset turnover, and financial leverage. The decomposition is sometimes referred to as DuPont analysis. DuPont analysis valuation ratios express the relation between market value of a company or its equity, for example, price per share, and some fundamental financial metric, for example, earnings per share. Ratio analysis is useful in this section in valuation and debt and equity securities, and as part of the credit rating process, ratios can be computed for business segments and evaluate how units within a business are performing. The results of financial analysis provide valuable inputs into forecasts and the future earnings and cash flows. Okay, so that is reading 26. Whew, I've been sitting here for 1.5 hours, just literally reading 26. I'm so glad it's done. Studying CFA level 1 do be kind of intense, and we have finished financial reporting and analysis section 2. We are going to continue financial reporting and analysis section 3 in our next reading, reading 27, study session 8. So I do hope my readings have been helpful, and I hope to see you guys in the next one. Without further ado, thank you for coming to my reading, and goodbye.